Module Overview. In this module, we dive deep into the advanced concepts, operational challenges, and strategic implications of the two primary accounting methods, cash and accrual accounting. This module explores critical adjustments, reconciliations, reporting nuances, and the business impact of each method. Understanding these advanced concepts enables accountants, financial managers, and business owners to make better informed decisions and maintain accurate financial records aligned with business goals and regulatory compliance. Timing differences and their impact on financial statements. Understanding timing differences. The fundamental difference between cash and accrual accounting is the timing of revenue and expense recognition. Timing differences create significant impacts on how profits and losses appear on financial statements. Cash accounting recognizes revenues and expenses only when cash changes hands. Accrual accounting recognizes revenues when earned and expenses when incurred, regardless of cash flow. Example: a company delivers a service in December but receives payment in January. Under cash accounting, revenue is recorded in January. Under accrual accounting, it's recorded in December. This can cause financial statements to reflect different profitability in different periods. Financial statement effects. Income statement. Timing differences affect reported revenues and expenses, causing variability in reported profit or loss between the two methods. Balance sheet. Accrual accounting includes assets like accounts receivable and liabilities like accounts payable, which are omitted in cash accounting. Adjusting entries. Ensuring accurate financial reporting. 9.2.1. The role of adjusting entries. Adjusting entries are essential in accrual accounting to align financial records with the matching principle, ensuring that revenues and expenses are recorded in the correct accounting period. Common types of adjusting entries: accrued revenues, revenues earned but not yet billed or collected. Accrued expenses, expenses incurred but not yet paid or recorded. Deferred revenues, cash received before services or goods are delivered. Prepaid expenses, payments made in advance for services or goods to be received in the future. Depreciation, systematic allocation of the cost of tangible assets over their useful life. 9.2.2 Impact of adjusting entries. Adjusting entries help prevent distortion of profits and ensure compliance with accounting standards. They provide a more accurate financial position and operational performance by recognizing obligations and resources that are otherwise hidden under cash accounting. Reconciling cash and accrual accounting records. 9.3.1. Why reconciliation is necessary. Businesses may maintain records on a cash basis for internal cash flow management, but prepare financial statements on an accrual basis for external reporting. Reconciling these two sets of records is essential to ensure consistency and accuracy, prepare tax returns correctly, meet regulatory requirements. 9.3.2 Reconciliation process. Start with cash basis net income. Add accrued revenues and expenses not included in the cash basis. Subtract deferred revenues and prepaid expenses included in cash basis but not yet earned incurred. Adjust for non-cash items like depreciation. Tax implications of choosing accounting methods. 9.4.1 IRS and Tax Authority Guidelines. The tax authority may restrict the use of cash accounting based on business size, inventory, or revenue thresholds. Accrual accounting is often required for corporations, businesses holding inventory, or those exceeding revenue limits. Switching accounting methods requires IRS approval and may lead to tax adjustments. 9.4.2 Impact on taxable income cash. Accounting deferred income recognition until cash is received, potentially deferring tax liabilities. Accrual accounting may accelerate tax liabilities by recognizing income when earned, even if cash is not yet received. Timing of deductible expenses also affects tax planning strategies. Strategic business implications and decision-making. 9.5.1 Cash flow management. Cash accounting gives a clear picture of cash flow, aiding daily liquidity management. Accrual accounting requires careful management of working capital to ensure cash availability despite profits on paper. 9.5.2 Financial analysis and investor relations. Investors and lenders often require accrual-based financial statements for decision-making. Accrual accounting better reflects the economic reality and long-term profitability of the business. 9.5.3 Business Growth and Scalability. Small businesses may initially use cash accounting for simplicity. As businesses grow, complexity and regulatory compliance often necessitate accrual accounting. Transition planning is critical to avoid disruptions. Common challenges and solutions. 9.6.1 Challenges. Complexity in preparing adjusting entries. Increased bookkeeping and administrative workload. Potential confusion during transition between methods. Maintaining dual sets of records for cash flow and reporting purposes. Solutions. Employing accounting software capable of handling both methods and generating reports accordingly. Training staff and management on accounting principles and software use. Consulting accounting professionals for transitions and tax compliance. Implementing robust internal controls and documentation standards. Practical examples. Example 1, small service business uses cash accounting to monitor actual cash receipts and payments. Minimal need for inventory or receivables management. Simple tax reporting, but limited insight into receivables. Example 2, retailer with inventory. Must use accrual accounting due to inventory tracking and tax regulations. Manages accounts receivable, payable, accruals, and deferrals. Provides detailed, accurate financial reports for investors and lenders. Example 3, company transitioning accounting methods. Experienced growing complexity and needed better financial insights. Prepared reconciliation schedules and adjusted prior year financials. Trained staff and implemented new software. Applied for regulatory approval for accounting method change. Summary. Understanding the advanced aspects of cash versus accrual accounting, especially adjusting entries, reconciliation, tax impacts, and strategic implications is vital for accurate financial reporting, compliance, and sound business decision-making. Mastery of these concepts helps businesses of all sizes choose and maintain the accounting methods best suited for their operations and goals.